Stephen Meade again, another Bullseye Guy podcast. This one was meant to be controversial, not in a bad way, but when I do the topic or when I say I'll never invest in equity again, people tend to say, well, what does that mean or why, especially VCs and institutional people that are always hung up on equity. I'm going to talk a little bit about why equity is a bit of a fallacy. All right. I know startups, we've done these for many years, but let me go through scenario A. Scenario A is a typical angel investor, $25,000, $50,000. Let's use the example of putting $25,000 or $50,000 into a startup. What are your chances of a return? Well, unless you're outside of somebody like Jason Calacanis that has an amazing rate of return, or Mike Walsh, you're at a 94% disadvantage on average of getting your money back. 90+% of the startups actually fail. So as an angel investor, you're already at a negative delta for the opportunity to get a return on your money. That's not a good position to be in, but we love being angels because angels supported us. We want to support others. It's this cycle of giving, but you're at a negative disadvantage. Let's say the company starts to do well. That first angel round was probably friends and family. Let's say it does another round, maybe a smaller round, and as the angel, you could top up, and I'm going to use a lot of terminology. Those of you in the investment side will get this. Others, you may not, but you top up to maintain your position. And that means is the next valuation, if you want to maintain your same percentage, you have to top up into the next round. And let's say you're able to do it for that next sort of super round of friends and family. Now comes the angel round, you're past that. Now's a Series A. By the time you get to a Series A, most angels can't top up their percentage. So as the company is more successful, it's getting traction and momentum and customers and revenue in a Series A, the angels now suffer dilution, which is fine because we own a smaller percentage of a bigger pie of a company that's more likely to be successful. But we're still at a negative delta because now we're diluted. Let's say it's a year or two or three later. Now the company's doing really well and it goes to do a Series B. What happens at the Series B? Now we're diluted even more. And either the B round or the C round, which is usually the big round, the venture capital guys come in, and we love, relationship. We love VCs. We hate them. VCs usually come in and have what's called a preferred position, which means they get paid before everybody else, and they'll do a double or triple liquidation preference. What does that mean? The guy in the B or the C round, not only are they putting money in and getting paid first on a preferred, they get double or triple liquidation, which means they get 3 times their money out before their investment, before distributions down to everybody else. So again, the angel suffered dilution, no say in the company, triple liquidation, and let's say maybe the company's successful and it gets acquired 5 or 6 years from now. Again, the angel has no say in that, or 10 years later, there's an IPO. That's the historical path of an angel investor, and that IPO is such a small thread. And again, there's opportunities along the way to sort of get out, but for the most part, in equity, you're either out and you lose your money, or you're in it for the long term, hoping that the company gets acquired or IPO. That's equity. Let's look at it a little differently. Let's say that you've had the opportunity to invest in a penny stock. Right now, penny stocks are risky, but so are startups. You'll see my point here in a minute. People again go, oh, I get equity. If you buy a 10-cent penny stock over the counter, OTC, risky, high risk investment, that company, if it goes bankrupt, your equity position, even though you own stock in that company, your equity is worthless. So as an angel, you don't have much say or optionality for a liquidity event. And if you do high risk, early stage over the counter, equity is really a fallacy. If the company doesn't make it, your equity is worthless. And the position you think you had for, quote, equity in the early stage risky companies really doesn't provide any value, any protection, or any say in the company. Now, if it's a bigger company or you can buy big positions, maybe, but for most people that are angels or early stage or retail investors, we're at a negative delta. We're at a bad position as the angel or the equity liquidity in an over-the-counter. Why is that important? Let's take a look at crypto. Now, many of you guys know this. If not, my philosophy on cryptocurrency, there's a bunch of different types, but simplistically, most cryptocurrencies, if we think about it in a simple context, they're glorified penny stocks. And I know some people want to fight me on it. Oh, it's a utility. It's a penny stock. It's a 10-cent token that you buy, hoping it goes to $1 so you can get a 10x. You don't buy a 10-cent penny stock to buy a cup of coffee, just like most people don't buy a 10-cent token to buy a cup of coffee. They're not buying it because it's a, quote, currency. They're buying it because they want it to appreciate. And there's nothing wrong with that. We want assets to go up. Where am I going with this? In the future, and it's already happening now, this will happen quickly. In the future, I believe all equity will be a digital asset. I don't believe there will be a stock market anymore of a distinction between a stock on the New York Stock Exchange or the NYSE or the OTC or the LAX or the ASX. And again, any of you guys that are in the market know I'm talking about London Stock Exchange or Toronto or Australia. All stock will eventually be digital assets. They have to be. There's such advantages to the digital side of having a digital asset versus traditional stock. And in one of my prior podcasts, it was with John Najarian, and many of you guys know him. We joked about this, and I don't recall if it was actually on camera or off camera, but there was this conversation of, will the crypto market ever be bigger than the stock market? And I said, in my opinion, it's a non sequitur, because eventually they will all be the same. There won't be a, quote, cryptocurrency. It'll be a digital asset. There won't be a stock. It'll be a digital asset. So Apple, IBM, Walmart, all the way down through NASDAQ, technology companies, all the way down through penny stock OTCs, all the way down through pink sheet pennies, all the way down to grays, will all be digital assets. Why? Well, let's talk about it for a minute. If you're a digital asset, right, we're calling them global asset offerings, a digital asset, there's distinct advantages over traditional stock. I'm going to pick primarily on the OTC, the over-the-counter, because most token projects are not IPOs. They're not initial public offerings, 10-year-old companies, 10 billion in revenue, $1 billion in EBITDA, $20 stock price. Like, that's a traditional IPO. Most of the token projects are really more like DTOs, and I've talked about this. They're more like direct public offerings on the OTC. A direct token offering is similar. What's the OTC? The over-the-counter market is this penny stock, sub $1 market. Let's talk for a moment about how it operates. If you want to be on an OTC company, there's two ways to do it. One, you can list. Most people do what's called a reverse merger. So you're reversing into an existing structure on the over-the-counter. Now, let's say that over-the-counter stock is trading at 10 cents. Everybody's goal on the over-the-counter, if you're legitimately building a project, right? Not if you're trying to pump and dump and scam people, just like in crypto tokens. If you're trying to pump and dump and rug pull, this doesn't work. But as an over-the-counter, your goal is to, quote, uplist. That means get your stock, your share price on the over-the-counter, that 10-cent stock, up to, I don't remember the requirements anymore. It used to be 4 and 40. So let's say your goal is to get your stock price up to $4 and your valuation or your public asset market up to at least 40 million. With that, you can, quote, uplist to NASDAQ. Now, why do you want to uplist? On the over-the-counter market, number one, there's a small amount of volume and liquidity. It's smaller investors. It's retail investors. It's the guy that might trade $50, $100, $1,000, $5,000. These are small, mostly retail, very little institutional money. When you're at the NASDAQ level, institutions can actually buy NASDAQ level stocks. So if you're a PIMCO, or I won't say BlackRock, a Blackstone, if you're a big investment group, a pension fund, most pension funds are precluded from investing in over-the-counter sub $1 stock. So just think about that for a moment. Got the biggest markets in the world in the United States, but institutions don't like to or aren't allowed to go onto the over-the-counter sub $1 stock. If it's over-the-counter sub $4, a lot of them can't go in because they're risky. They're early stage projects. They haven't matured, harder to do due diligence. Again, all of this starting to sound familiar to not only crypto projects, but startups. And I'll close that loop for you in a minute, but the goal of an over-the-counter is to uplist to NASDAQ. On crypto, on a digital asset, there is no uplisting, it's multi-listing. And again, these are terms I'm creating on the fly because you have to. If you're an over-the-counter, I keep bouncing around, over-the-counter, OTC, you're a US public over-the-counter penny stock microcap company, and you want to uplist to NASDAQ. You can also multi-list, dual jurisdiction. You can also list in TSX, the Toronto Stock Exchange, or ASX in Australia, or London. You can pick, but it's time consuming, it's expensive. Again, though, you're trying to get more liquidity in digital assets, cryptocurrency, again, digital. You uplist to multiple exchanges. Your digital asset can list on exchanges around the world. You're talking about massive liquidity, massive number of potential shareholders, massive numbers of people that can hold your crypto digital asset in any form, fractional. So again, if Bitcoin's at $50,000 and you can only afford $50, you can buy a fraction. If your token is at $10,000 and you can only afford 100, you can buy 100. In traditional stock, it's very difficult for people to make big purchases. That's why in the stock world, they do splits. You're always trying to split the stock to keep that price in a range where more people can buy it. Digital assets, you don't have that. You can buy in fractions. So if you own a digital asset versus over the counter, you've got multi-jurisdiction, multiple exchanges around the world, the ability to buy in fractions, the ability to market into exchanges that might be in a country or jurisdiction or somewhere you want to be. There's more opportunity to get liquidity. It's a big deal. Second, in the reverse mergers, again, if this is too professorial or too inside baseball, I apologize. But for the people that get it, it's important. Often when you do a reverse merger into an existing public company, you're trying to get liquidity. You want to be able to have a public stock that allows your investors to have liquidity. The person that owns that public stock, if the stock is trading on the exchange, the over-the-counter, and it's got some volume and doing well, that investor has a chance to actually sell and get an exit versus equity that, again, I'll come back to. There's some other challenges within the over-the-counter market. If you reverse into a company, too often there are hidden shares. There might be stock that you're reversing into a company and it's like, what's in the closet? Often there's somebody that holds public shares or private free trading shares. So while you think you have control, all over here in these trading platforms and in these transfer agents, there's stock that you don't have visibility into. Digital assets in crypto, again, crypto, but the digital side fixes a lot of that. The transparency into where the assets, the number of digital assets created. If you say, I created 200 million assets for my company, that's on the chain. It's on blockchain. It can be audited. It's transparent. If those assets are being transferred around, it's all available in the public side. Traditional stock, that's all hidden. And it's hidden in fascinating ways, not only free trading shares. I've done some research. I was curious just from a comparison. I want to know how many shareholders Apple has or Amazon. If you go online, if anybody can find this, I would love to know, but I haven't found the statistics to say Apple has this many shareholders. Most of the money held in Apple and Amazon and the big stocks are held in blocks by institutions and pension funds. That's really where the big market is. The number of retail individual stockholders in Apple, I'm guessing might be 15 or 20% of the total shares. I'm guessing. If anybody has research, I would love to know that. Again, why is this important? In a digital asset, you can have contributors, participants, digital assets, shareholders. I don't like calling it share, but that digital asset you could sell to millions of people globally. As you list on multiple exchanges, you're picking up liquidity. You're picking up shareholders. In an over-the-counter, the OTC penny stock, if you have 5 or 10,000 stockholders or shareholders, that's a big liquidity pool. The goal's 5,000. If you get to 10 or 15 or 20, boy, that's a big number because you've got a lot of liquidity and velocity and buyers and sellers to make your stock active. In a digital asset, you can blow that up, but you've got transparency for the number of assets and digital shares that have been issued. In the public markets, it's a lot more controlled. It's a lot more hidden. Even though you think the audits are there, it's really, really challenging and cumbersome. So the transparency side of the digital asset, again, I call it a global asset offering. The transparency of a global asset offering. If you're a company that wants to raise money, you say, I'm going to raise 10 million or 50 or $100 million, and I'm going to reverse into an over-the-counter. I'm going to reverse into an OTC. I'm going to try and audit. I'm going to try and find all the shares. I'm going to market to the OTC base and hope to uplist on NASDAQ. You can do it. There's a path for that. There's a process. There's companies that do it. You could say, I'm going to do a digital asset, a global asset offering that we've structured a couple out of Bermuda, and say, I'm going to market this digital asset globally. I'm going to market to a larger base of potential shareholders, and I'm going to drive liquidity across exchanges around the globe. Totally different execution of what happens with a digital asset or a global asset offering or a digital token. So again, this concept of a cryptocurrency, eventually I think everything's going to be digital assets. Why is this important to equity? Why did I say I won't invest in equity? Well, as an angel, right? I'm not the institution level. At the angel, the opportunity, and this is where, again, I'm going to name drop here. I wish Kevin Harrington, not Kevin Harrington, my buddy Kevin, Kevin O'Leary, there's Shark Tank. I know Kevin. I wish that Howard Marks and the Start Engine and the guys that do crowdfunding for equity, eventually they'll get their mind around this. If a startup came to you and said, I'm going to raise money, and yes, we have equity and we'll give you some, but I'm going to do a token. I'm going to do a digital token. And right now, true, the token has no value. It's not traded on an exchange. There is no market. There is no liquidity. Nobody cares about, nobody's even heard of our company. But if we start being successful, if we start getting a little bit of traction, we might, as a company, try and list that token on an exchange. We'll try and build a support system for it. We'll do some marketing. We'll do some press and PR. We'll try and drive the value of that token up. As an angel investor, I now have optionality. If I own a token, right, I still can own equity, but that equity is long-term. If I own a token and that company is successful, instead of doing a Series A, they might actually do a token round and raise money through the token and not take dilution in the equity round. They might spend some time and effort marketing that token and presenting and promoting it early. So as an investor, as a token holder, as a digital asset holder, I am more protected with a token that has potential liquidity, full transparency into the offering. Unlike equity, I usually don't know what's really on the cap table. I hear about it. I have some documents, but if anything were to happen, it's a heavy lift to try and sue a company and see what the cap table is and understand where things are. There's no transparency in a true startup. It's just too difficult. There's very little transparency in an over-the-counter. Now, people may argue with me on the transparency, but anybody that knows OTCs and reverse mergers, there's always free trading shares and things that are hidden that don't get out there. So if we look at this for a startup to say, I'm going to A, try and raise money. I'm going to use a digital asset to do it. Now, again, you can still tie it to equity. There's some interesting threads, but I'm going to use a digital asset. I can now sell in fractions. I can market this internationally. I can raise capital Again, legal restrictions, there's some ways to do it, but I can raise capital and my token holder, my digital asset holder knows what I filed. They have transparency into the token generation, how many have been issued, what they are, the contracts, the pricing, everything is there. And if that company starts to become successful, they might list a token, even if it's on a small exchange. That's what we're doing with the strategy. We're using Centurion, which is a licensed exchange out of Estonia. Smaller exchange, smaller volume, but it's a great starting point. It's a launch pad to say, hey, we're going to start the tokens here. We're going to build some liquidity, build some momentum, get some traction, and then uplist onto bigger exchanges with bigger volume. The strategies are coming, guys. The global asset offering, the digital assets, the concept of equity is a fallacy in an OTC. In an early stage company, equity is a fallacy. If the company goes under, equity is irrelevant. Now, you could try and sue and get assets, but for the most part, equity as a startup is a fallacy. Equity doesn't give you the protections you think it does. Bottom line is no optionality for liquidity. Angel investor, you're in that stock, you're in that equity until there is an exit, an acquisition, an IPO. For the most part, that's it. Or the company doesn't make it. If it's a token, even if it's trading a little bit, if it's trading a little higher than your price, even if it's trading lower, you might still have optionality for liquidity that you don't have in a traditional equity investment. So that's why, again, when I say that to be controversial, I'll never invest in equity. Not that equity is bad, but it doesn't have the functionality, right? The digital tool, the digital asset, what blockchain provides from a transparency, from an audit, from a liquidity, from a fractionality standpoint is massively advantageous over traditional equity. That's what I mean by that. Again, love the industry, love the space. I think a lot of changes are coming, but as you look at the market, as you look at the industry, as you look at crypto and look at equity, understand everything I believe will eventually be digital. It has to be. It's better for the investor. It's better for the market. It's better for the regulators. There's more security, more transparency, more transportability. Everything has advantages in the digital world. So again, where did I talk about this with John Najarian? There will not be a crypto is bigger than the stock market, because in the end, they'll all be the same thing. They'll all be digital assets, whether it's a digital asset on the New York Stock Exchange, or whether it's a digital asset in a crypto offering like an OTC, or whether it's a digital asset in a startup that's trying to raise money, they will eventually all be digital. They have to be by default. So that's it. Stephen Meade, the Bullseye Guy. Always great fun, great opportunity. Appreciate it. Tune in for the next one.